Hello and welcome to the third episode of Buying My Freedom. My name is Steven, and this week we're going to do my portfolio breakdown. So if we take a look here, you can see my spreadsheet. If you're new to investing, this can be a little overwhelming. There's a lot of information here, and most of that information probably doesn't mean much of anything to you. If you're not new to dividend investing, then you'll know exactly what's going on here. But we're going to go through all my different holdings. I'll explain a little bit here about my investment thesis. I'm a dividend growth investor, so I want the base portfolio value to rise over time. There's growth, or at least one aspect of growth, and I only buy stocks that pay me. If it doesn't give me some form of dividend or distribution over the course of the year, then I'm not going to buy it. If it doesn't pay at least quarterly, I'm not going to buy it. My strategy relies on compounding over time and dollar cost averaging. And I'm trying to be really aggressive here. So if I were to buy into a semi-annual dividend stock, like let's say Disney, it wouldn't really help me all that much. And I also want to explain something right out the gate here because this is going to be referenced throughout my whole summary of what's going on with this portfolio. What is a dividend challenger, a dividend contender, and a dividend king? So a dividend challenger is a company that has been paying and raising its dividend for anywhere between 5 and 9 years. A dividend contender is a company that has been paying and raising its dividend for anywhere between 10 and 24 years. And a dividend king is any company that has been paying and raising its dividend for a consecutive 25 plus years. Why is this important to me? Because the longer that a company has had a streak of paying and raising a dividend, the more it has on the line with its investors. If you've been paying for 25 plus years and raising it for 25 plus years, that's quite an achievement. And it's something that you want to maintain if you've been doing it for a long time. And most companies that are dividend kings are large cap companies that are stable and well established in the United States market. You're going to hear these terms throughout this video. You needed to know what they are. Now, without further ado, let's go ahead and get into this. All right, so first up, ticker BMY. This is Bristol Myers Squibb. This company is a healthcare company. It's a dividend contender. It's been paying and raising its dividends for 18 years. It has an average 5-year compound annual growth rate of 6.24%. It's exactly what it sounds like. On average, over the last 5 years, this company has raised its dividends 6.24%. This is a metric that you can use not only to back test the company, but also to anticipate what future dividend raises might look like. Dividend growth investing, growth is important. It's not just the growth of your principal. It's also the growth of the payouts over time that are important. This is what helps us compound faster and get to a retirement where we don't just have a stagnant wage. The whole point of buying companies that pay dividends is they pay me without me having to sell my principal. If you're going to work hard to build up a portfolio of anywhere between, I don't know, $500,000 and maybe $2 to $3 million, why would you want to sell that? That's why I don't do straight growth investing. That's why I don't go for the 4% rule. I'm working hard to build a principal and a well-structured portfolio. I don't want to sell my principal, but I still want to get paid. And this is the way that I've chosen to do it. But anyway, back to Bristol Myers Squibb. Being a dividend contender is important. That 5-year growth rate is important. It gives me exposure to healthcare. And what do they focus on in healthcare? They do cancer drugs and hematology drugs. Well, for the foreseeable future, people are going to keep getting diagnosed with cancer, unfortunately, which means that this company is going to keep making money to treat cancer. Hematology drugs. That has anything to do with blood. The first thing that comes to mind when I think of hematology is older people. Older people usually have to have things like blood thinners. And that is something that just happens with old age. Both of those things they offer consistent stability. Something else that's not really part of the base case for Bristol Myers Squibb, but is part of the case for why I think it's a buy right now, is the higher than expected earnings that they announced in the last quarter. Moving down, ticker ES. This is Eversource Energy. This is a utility. They're a dividend king. They've been paying for 25 years. They just achieved their dividend king status. You bet they're going to try to hold on to it. Their 5-year compound annual growth rate is 5.73%. They do electrical, they do natural gas, they do water. They have investment in solar facilities. So they're looking towards the future with that. Most houses use natural gas for either heating or cooking or both. Everyone needs water. And another part of the bull case here is how widespread their utility service is. So they service residential, commercial, industrial, and municipal lines. So they have a pretty strong base for their income. And being a dividend king, I don't think they're going anywhere anytime soon. Next ticker, Flowers Foods. This company is one that there are a lot of bears for. A lot of people think that Flowers Foods is a yield trap. I don't know if Flowers Foods is a yield trap. I just know that I like their portfolio in terms of what they do as a company. So I'll explain this a little more. They're part of consumer staples. They're a bakery. They make bread. They make snack cakes, English muffins, bagels, you name it, tortillas. They've done it. They're a dividend challenger, so they've been paying and raising their dividend for 12 years. They have a 4.35% 5-year compound annual growth rate. They're part of consumer staples. Bread has been a staple of humanity forever. So it's naturally a recession-resilient industry to be in. Big brands that they own that you most likely know. Nature's Own, Dave's Killer Bread, Wonder Bread, Tasty Cake. Their customers include grocery retailers, convenience stores, restaurants, military commissaries, and prisons. I don't know how much more of a case I need to make for Flowers Foods. I think it's an undervalued company. It currently pays a really high dividend. I think the dividend's like 11% right now, which is insane. That's why people think it's a yield trap. And they have a considerable amount of debt because they just acquired the company over the last couple of years that owns Dave's Killer Bread. So yeah, they need to pay down that debt. But at the end of the day, it's a bakery, it's a bread company. They own like 30% of the baked goods market in the United States. I don't see them failing anytime soon. I really don't. Next up, we've got HP Inc., Hewlett Packard. This is a household name. It has been a household name for my entire life. Obviously, they're part of information technology. They do computers, they do printers, you name it. If it's computer related, they probably do something with it. So yeah, their sector's information technology. They're a dividend challenger. They've been paying and raising their dividend for 15 years. They have a 9.76 average 5-year compound annual growth rate. My bull case for it? Tech is becoming more and more integrated into our lives. Even if there's another big tech bubble looming on the horizon, I don't think that HP is going to be wiped out by it. They are pretty much vital to the business and home computing space. And then another little thing, this is a growing market that they're part of, is 3D printing. I believe that 3D printing is going to become more and more of a part of our lives as opposed to just being a hobby that some people do. Next company up, Hercules Capital Inc. Hercules Capital is a business development company. They are a dividend challenger. They've been paying and raising their dividend for 7 consecutive years so far. Their 5-year compound annual growth rate is 6.33%. What do they specialize in? They provide financing to companies so that they can grow. They specialize in financing initial public offerings, so any company that is about to become a public company on the stock market that you can buy, they help finance all the things required to make that IPO happen. They finance mergers, they finance acquisitions. If you're doing a merger or an acquisition, you're merging or buying another company for a reason. Like, you're not going out of your way to buy something that's going to lose you money. Of course, Hercules Capital is offering loans to companies, so they're not in the business of losing money either. They're probably getting a very favorable interest rate from these loans. Other things that they focus on, they like to have exposure to semiconductors, geothermal energy, and biotech. Semiconductors, again, that's a bull case for technology. Geothermal energy, that's a bull case on my part for renewable energies. And biotech, well, if you've seen the development of medicine over the course of the last 20 years, I don't see how biotech can't be a profitable venture in the future. And also, they do a lot of investing in private companies, so this gives me exposure to companies that I otherwise would not have had exposure to. Next up, we have Main Street Capital. This is categorized in the financials sector. This is another business development company. They're a dividend contender. They've been paying for 18 years. They have a 4.46% compound annual growth rate. They invest in small businesses, hence the name Main Street Capital. Their focus in terms of who they help out is consumer discretionary and consumer staples. So this makes Main Street Capital theoretically more recession resistant. Their portfolio is also very, very diversified. I was looking at the list of sectors that they're exposed to. It's pretty much any and every industry that they can get into that fits this I'm helping small business owners mindset. Next up, Merck & Company. This is another healthcare stock. It's a dividend contender. It's been paying for 15 years. It has a 6.68% compound annual growth rate. It has international healthcare exposure, so we're not just looking at the US here. And Bristol Myers Squibb is also international. 15 years of dividend payout, 6.68% compound annual growth rate, international healthcare exposure. They make veterinary medicine, so who isn't going to pay for medicine for their dog? Well, most people are going to pay for medicine for their dog or cat or whatever. And they have a very strong history of dividend growth. Next up, also known as Realty Income Corp, aka the Monthly Dividend Company. They are a real estate investment trust. Now, historically, real estate has been extraordinarily profitable. Countless people have built their retirement on owning real estate. They've built all kinds of wealth on owning real estate. But owning real estate can be a big headache, so I like to buy REITs. Realty Income Corp is a dividend king. It has been paying and raising its dividend for 32 years. It has a 3.35, it has a 3.53% 5-year compound annual growth rate. It is an S&P 500 company. It operates in the US and Europe. It boasts tenants such as 7-Eleven, Lowe's, and Chipotle. Other companies in its portfolio include, but are not limited to, Dollar General, Walgreens, Dollar Tree, and FedEx. I don't know about you, but all those companies seem pretty darn stable. And Realty Income Corp specializes in having a high retention rate for its tenants and having a very reliable portfolio that pays them regularly. Next up, One Main Financial Holdings. It's a finance company. They specialize in loans and insurance. It's a dividend challenger. It's been paying and raising for 6 years. It has a 21.79% 5-year compound annual growth rate. Now, I look at that 21.79% and I say to myself, there is no way that growth rate is sustainable. So that growth rate is probably going to average down over the course of time. I wouldn't be surprised if it stabilizes around 8 to 10%. But obviously, they were going aggressive so that they could get more dividend investors initially. I wouldn't put any faith in that 21.79% being a regular thing. Like I said, they do loans and insurance, so they do auto financing, credit cards, and other optional forms of insurance like life insurance. And all of those things are extraordinarily profitable. So I'm willing to take a risk on a dividend challenger like this. They are, from what I was reading, they are very selective about who they loan to. That also makes me feel better as an investor. Next up is Paychex Inc. It's a payroll company. It's categorized under industrials, which I don't quite understand how Seeking Alpha categorizes everything, but that's the category that it had, industrials, but it's a payroll company. It's a dividend contender. They've been paying their dividend for 12 years. They have a 5-year compound annual growth rate of 11.74%. All companies need payroll. Whether they do it themselves or they're a bigger company and they have to hire it out, all companies need payroll. That's a pretty easy bull case. They have operations all over the US, Europe, and India. That's a well-diversified company with a broad potential client base and a broad regular client list that they've been maintaining. PNC Financial Services. I have a lot of exposure to finance, as you can see, but it's all different sectors and categories of finance. So I'm getting exposure to the whole broad financial market here. They're a dividend contender. They've been paying their dividend and raising it for 15 years. They have a 7.81% 5-year compound annual growth rate. They service a really broad customer base. They do everything from retail banking, which is Joe Schmo, to corporate and institutional banking. So they run the gamut. They'll do anything and everything. As long as your money's good, they'll take it. The other part of the bull case here, it is a big, old, established bank. They've been doing business since the 1800s, and they still haven't gone out of business. I feel like they're going to be around for a long time still. Next on the list, SCHD. This is one of 2 ETFs in my portfolio. It is the Schwab US Dividend Equity ETF. They have been paying their dividend for 14 years. Their 5-year compound annual growth rate is 9.15%. They do an annual rebalance to account for changing market conditions. They do their best to maximize the dividend payouts. They only buy US dividend equities, and then they pass those profits on to the investor. So this is a great way for any dividend investor to get relatively stable dividend payouts without you having to really focus in hard on what all your individual holdings are doing. I love SCHD. It helps me get exposure to the bigger dividend companies that I might not include in my portfolio because I think their payout is too low. It adds a level of stability to my portfolio, and they're probably going to see things at Schwab that I'm not going to see. I don't know how I missed this. Skyworks Solutions. Give me 1 second here. When I was preparing my notes, I didn't do a very good job. All right, Skyworks Solutions. So, Skyworks Solutions is a company that specializes in things like radio tuners and other various components that make your electronics work. It has exposure worldwide. That's the bull case. That's it. They're a dividend paying company that manufactures components that go into all kinds of devices. T. Rowe Price. Back into financials, specifically retirement planning. T. Rowe Price is a company that I've heard about my whole entire life. They are a dividend king. They've been paying and raising their dividend for 39 years. Their 5-year compound annual growth rate is 6.21%. What's my bull case for it? They make money by helping other people make money. There are a ton of people out there who don't want anything to do with managing their portfolio. They want someone to do it for them so it can be on autopilot and they don't have to worry about their retirement or learning about stocks or any of this stuff. And that's fine. If that's not your forte, that's not your forte. But as a dividend investor, I see a dividend king like T. Rowe Price and I think, well, if they're paying a dividend anyway, this means I can make money off of other people investing, and that's pretty darn cool. So that's the premium you pay for having someone else manage your money. Vici Properties, another real estate investment trust. They are a dividend challenger. They've been paying their dividend for 7 years. I was turned on to this company by another finance YouTuber named Joseph Carlson, who actually really got me into dividend growth investing. Back when COVID happened, he was the channel that I watched to learn as much as I possibly could, primarily, before I went ahead and dove in. It was very, very helpful. The 5-year compound annual growth rate is 6.72%. It is another S&P 500 company. The big reason why I love this company is because it holds leases on casinos. Casinos have their up times and their down times, but as a rule, casinos have a tendency to be extraordinarily reliable when it comes to their profits. In fact, they're so reliable that a lot of casinos have 30 to 50-year leases. That's a pretty darn long time. That's a lot of financial stability, and you know a ton of money comes in and out of those casinos. So this is a very, very good real estate play in my eyes. All right, now to the last ETF that is in my primary portfolio. WEEK, the Roundhill Weekly T-Bill ETF. Really easy to understand here. It buys treasury bills and pays me a weekly dividend based off of the yield from those treasury bills. The value of this is pegged to the dollar, so there aren't big price fluctuations. It's usually fluctuations of a few cents, and that's about it. So this is my portfolio stabilizer. If something goes tits up, Week's there to help keep everything in check. It pays a consistent dividend that is tied to the general interest rate set by the Fed. And since it's all backed by the U.S. Treasury, the only way that this is really going to go screwy on me is if for some reason the United States government just completely disintegrates. And if that happens, we have a lot more problems on our hands. So, you get a little bonus here too. I have a secondary portfolio. This does not contribute to anything related to the primary yet. So I had some Bitcoin, but I sold my Bitcoin today to buy into YMAX, which is the Yield Max Universe Fund of Funds. This portfolio is completely speculative, but the idea of buying YMAX, and I know that Yield Max ETFs are extraordinarily unstable. I've had bad experiences with them, but if I'm throwing in money that I don't care that much about into this, and it happens to be able to buy me Bitcoin over time, that's the goal. So I sold my Bitcoin to buy a good chunk of this. I'm going to grow my YMAX position to a certain point, and then I'm going to start feeding Bitcoin money from YMAX. And I have a bull case for Bitcoin specifically. I think that since Bitcoin is deflationary and big institutions have been buying Bitcoin left and right for a couple of years now, that there is no good reason why Bitcoin can't eventually be valued at $250,000 or more. This is my way of being able to get Bitcoin exposure without putting my primary portfolio in peril, without taking away from my primary funding for my primary portfolio. So now we've gone over all the individual positions. If we take a look here, I have all kinds of different categories here that I'm stealing data from. Update my number of shares. I update the average price. I keep track of the market gain and loss. I keep track of the current portfolio value, and I keep track of how much I paid for everything. I have the annual dividend per share for all these different holdings listed here. I also have my cumulative dividend per share here. So that multiplies this number by the number of shares I own to tell me how much I'll make annually based off that share count. I've input my 5-year compound annual growth rates into this column. So I multiply my cumulative dividend by the compound annual growth rate so that I can project out what my eventual 1 year in the future dividend might be. And over here, I've got my portfolio summary. As you can see, my portfolio is currently in the red. I've contributed $13,295.72. The current value is $12,923.69. I'm down 2.8%. That's fine. That means my stocks are on sale. There's nothing catastrophic going on here. My yield on cost is 5.86%. My dividend yield overall is 5.69%. Projected total annual dividends without buying anything else is $756.69. My calculated dividend annual raise is about 6.65%. And this is just a projection. I have a projected annual raise. This is based off of the averages of those compound annual growth rates. And I also have the projected yield for 1 year in the future. So that's just dividing my projected total dividend income next year by the current portfolio value. And I like to do some fun stuff here with it too. So I do my estimated weekly payout, which is $14.55. I do an estimated daily payout, which is $2.08, and an average hourly payout, which is 9 cents an hour right now. And then I get even wackier. Pay by the minute, 0.00144 cents. Pay by the second, 0.00002 cents. And it's just a little bit of fun. There's no reason for me to actually track those numbers, but I enjoy it. I keep track of my margin use, so down here, this 82.29% is the amount of margin that's available to me. So it's not matching the portfolio value 1-to-1. That's 82% of 50% of my portfolio value. And then I have my portfolio value with Robinhood and my speculative individual portfolio value, which I broke when I updated things. So we'll come back to that at some point in the future. Anyway, I know that this was kind of rambly. I hope you got something out of this. This is my portfolio breakdown. These are the holdings that I'm working with and trying to grow so that I can eventually retire within the next decade. If you like this video, please leave a like on it. Leave me a comment. Tell me what you think of my portfolio. Tell me how good or how horrible it is, and tell me why. If you do both those things and you feel so inclined, please subscribe to the channel. And with that, have a fantastic week. Bye.